2024. OMG, what happened? Well, let's find out. I am Justin Miller with the Chung Miller Group. At the Chung Miller Group, we help people build wealth through real estate. In this video, we are looking at the market update for January 2025. And what that means is we're looking at data from December of 2024. And since that's the end of the year, I will do a whole annual recap on what happened across real estate in the Las Vegas Valley during the year 2024. Not at the micro, here's a super high price sale or this person got an absolutely amazing deal, but rather larger descriptive statistics so that we can understand what's actually been taking place in the market in 2024. Okay, so the first thing I want to note is interest rates. I want to note interest rates not because this is an interest rates video, but because interest rates have been so significant in underlying what's going on in the real estate market in general, right? Because more than 3/4 of people in the market almost all of the time, including in 2024, are buying properties with mortgages, right? There are some people who pay cash for a property, but that number tends to be something approximately 25% plus or minus a slight bit. In 2024, we actually saw cash buyers representing a pretty normal share of the marketplace. So that means 3/4 of all buyers are using a mortgage to acquire the property that they are trying to buy. And it likely means that 3/4 of sellers will be paying off a mortgage on the property that they're actually selling as well. So kind of both sides of the marketplace here. So interest rates have been really consequential to how this market is functioning. Some people, sellers, may have felt locked into their home and their mortgage because their home price may have appreciated over time, but their mortgage interest rate was so low that they may end up selling and buying even a smaller property and having bigger monthly payments because their mortgage interest rate in 2024 would be quite large relative to what they had been paying on their mortgage previously. And by the way, just remember that most people who end up having a mortgage on a property can refinance that mortgage to get a lower interest rate when interest rates have come down. And mortgage interest rates were very, very low in the period 2020 through 2020, for the first half of 2022. So many people in their existing properties are holding mortgages of 2.25%, 2.5%, up to 3%. Some people did not refinance, and so they got into properties in the prior few years from that when mortgage interest rates tended to be around 4 to 4.5%. But now mortgage interest rates are considerably higher. So let me talk for a minute about interest rates, and then we'll shift our attention to sort of the macro numbers within the Las Vegas region economy as related to housing specifically. So the first thing I want to note is in 2024, and I've noticed this in my market update videos throughout 2024, we saw 30-year fixed rate mortgages. That's a mortgage that most everybody takes when they get a loan. You could do a shorter duration, like a 15-year fixed rate loan. There's no good reason to, because you lock yourself into higher payments to pay the mortgage more quickly. You could do that yourself on a 30-year fixed rate mortgage, and you could just pay extra payments every month and pay it off in 15 years. But you have the flexibility of not paying more quickly if you don't have the wherewithal in a particular month or a particular couple months, you want to go on vacation, whatever it happens to be. So getting into a 15-year fixed rate loan does not actually make any economically good sense. So most all loans, 30-year fixed rate. Now there are variable rate loans as well, adjustable rate mortgages, and those come in various flavors, 5-year, 7-year, 10-year. There can be ones that actually reset on basically a monthly basis as well, depending on what the underlying index is that adjustable rate mortgage happened to be tied to. But because the spread between adjustable rate mortgage interest rates and fixed mortgage interest rates has been relatively narrow over this past year. Very few people are actually getting into adjustable rate mortgages. So again, the vast majority of people who are buying with mortgages, 75% of the market, are buying with 30-year fixed rate mortgages. So the interest rate on 30-year fixed rate mortgages is the index that we want to tie our analyses to understand what's actually going on. Well, throughout 2024, interest rates on 30-year fixed rate mortgages have been at 7.0% plus or minus 0.3%. So from 6.7 up to 7.3. And I'd commented on that at multiple times in my market updates over 2024. The interest rates were holding pretty steady. They were holding in this band. And yeah, it's a little bit better to be near the bottom of the band if you get into a mortgage than to be near the top. But on average, rates were holding around 7%. Now, we actually saw a significant drop in mortgage interest rates starting in late August. Late August through the 17th of September, we saw 30-year fixed rate loan mortgage interest rates come down from about 6.8 down to about 6.3%. That was a really significant drop, and it's 50 basis points, it's half a point. And that was predicated on the understanding that the Fed at its September 18th meeting was likely to be cutting the Fed funds rate. And the Fed did. They cut the Fed funds rate by 50 basis points, by 0.5%. But the result in the mortgage bond market was concerning. Mortgage interest rates went back from 6.3 back up to ending the year, right? So that's mid-September. So we've got 3.5 months. In that 3.5 months, interest rates have gone back and ended the year of 2024 at 6.99%, according to the Mortgage Bankers Association, MBA. Right, so MBA looks at mortgage interest rates broadly across all of the conventional loan types across all of the country. And so you could find, maybe talking to a particular bank, a lower rate. You could look at somebody else's statistics and you may see variation on that. But I always use the MBA.org interest rate information, because that way I'm looking at a consistent set of this is how interest rates are responding. So interest rates had come down 50 basis points, and they've gone back up by the end of 2024, 70 basis points. And here we are sitting at the end of 2024. It's 7%. It's 6.99% on fixed rate mortgages. So that's really significant. And by the way, in contrast, the fixed rate mortgages, 30-year, that were being written in the second half of 2020, all of 2021, and the first half of 2022, those mortgage interest rates were being written at below 3%. So at 7%, we're more than double on that. And that, because 75% of people buy houses with mortgages, that means that the carry cost, the monthly out-of-pocket for people who are exposed to mortgages, has risen really substantially. We'll look at a statistic about that in a couple minutes. One other thing on interest rates before I shift my attention to the next issue. The Fed funds rate, just to give you an idea of how impactful the Fed has been with regard to the interest rate market. The Fed funds rate in April of 2020 was lowered to 0%. Now, the statistics I'm going to give you are effective Fed funds rate. The Fed actually figured they would not be able to control interest rates at that level with a point specificity. So they started setting a range of 0 to 1/4 of a point, 0 to 0.25%. But there's kind of a calculable effective rate as we look backwards, and we can see that the calculable effective rate varied between 0 and 0.3 during a 2-year period until April of 2022. But between April of 22 In March of 23, the Fed funds rate had gone up to 4.57%, from virtually zero, a quarter of a point basically, up to well over 4.5%. And that continued to increase until August of 2023, when it hit 5.33%. And that stayed there until we got to September 18th of this year, at which time it was cut by 50 basis points. And by the end of the year, in November and December, 2 more 25 basis point cuts, we've actually seen the Fed funds rate come down 100 basis points, or 1%, from where it had gotten to. Now, the Fed funds rate, remember, that's the only interest rate that the Fed literally controls. Other interest rates just simply take a cue in the trading market and trade off information contained in the Fed funds rate. But the Fed does not control those other interest rates, which is part of the reason why, as the Fed lowered its rate in September of 2024, we actually saw mortgage interest rates go higher. Now, the other thing to think about with regard to the signaling rate, this overnight lending rate between banks, when the Fed adjusts this, they're signaling to the market that they want interest rates to be going higher or lower. Well, who's the market? The market are bond traders. They may be institutions, they may be governments, they may be individual people who buy and sell bonds. Those could be treasury bonds, they could be mortgage-backed securities, they could be auto loans, they could be credit card debt. All of those things that have interest rates, those are all traded in the secondary market. And as demand for those bonds goes down, or supply for those bonds goes higher, what we see is that interest rates go up, right? Because there's not enough people competing to buy the bonds in the market. That causes the prices to fall, and interest rates are directly inversely correlated to the price of the bond. So if a bond goes down in value because fewer people want it, that means interest rates went up in value. You could think about it conceptually as a higher interest rate is needed to attract the bond buyer who did not otherwise want that bond. So interest rates and bond prices are directly inversely correlated. So what the Fed has done is they've signaled what they want the interest rate markets to be doing, but their signal is perhaps increasingly weak. So that's my interest rate note for this video. Let's talk about what this has done in the marketplace for housing, right? Because as I said, interest rates have gone up more than doubling. That's caused the cost of carry on a home to go up very considerably. And we'll look at some specific numbers about that in a couple minutes. But what does that do to the market? It makes it more expensive for buyers because buyers have to pay more every single month on their mortgage. And it makes it harder for sellers who may feel that they're locked in on their particular properties. The latter reduces the inventory in the marketplace. The former reduces the number of buyers who may be looking, and therefore demand in the marketplace. So let's look at what actually has taken place. The rolling 12-month sales. Now, this number represents the total amount of activity, sales transactions that have taken place over the year of 2024. And I'm going to give you a comparison to 2023. 2023 was the weakest year we had in overall transactions since the prior generation, right? Since the late 1990s. A little bit of aberration in certain markets like Phoenix and Las Vegas, where we had a very significant impact of the global financial crisis in the 2006-2007 timeframe. But we were looking at generational lows in 2023. Well, how did 2024 compare in terms of transaction volume to 2023? These are the final numbers for 2024, so we know actually what these numbers look like now. I'm reporting them here. 2024, single family residential resale units in the Las Vegas Valley, 20,919. Now, it turns out that's up 3.3% from the historically low levels achieved in 2023, which was 20,251. Okay, so that's single family homes. What about with regard to condos? 2024, we saw 3,615, so a much smaller number, right? 3,615 condos closed. That's up 4.5% from the 3,459 that closed in 2023. And what about for townhomes? Townhomes, we saw 2,235 closed, and that's down. It's down 8.6% from the number of townhomes that closed in 2023, 2,446. Across the whole of the market, then, if we accumulate those and we can look at the totals, January through the end of December, January 1st to December 31st, 2024, we had 26,769 total housing unit transactions that took place. That's up 2.3% from the 25,156 that closed in 2023. 2023, historically low, lowest in a generation, and we're up 2.3% from that. Now, in looking at these numbers, there is something else that I've alluded to, especially in my condo and townhome market update videos, and that is the condos represent a small portion of the market, and townhomes a very small portion of the market. Since I have the cumulative numbers for 2024, let me just give those to you here because they are kind of interesting and certainly very confirmatory of that statement. In 2024, closed transactions, single-family homes represented 78.1% of the marketplace, so almost 80%. Condos represented 13.5% of all of the transactions that took place in 2024. And townhomes, 8.3%. So townhomes are barely half of condos, and condos represent only 13.5% of the marketplace. So when I talk in the condo and townhome market update videos about small number issues and how transactions in the townhome market can increase or decrease certain percentage calculations, even with just small number changes, it's because of that. It's because it represents such a small portion of the marketplace. True for condos, true for townhomes. Okay, so that means that we were looking at small numbers. Well, let's contextualize this a little bit more. And I want to contextualize it in a particular way, and that is with regard to a recession. So recession is generally defined as a period of significant, although temporary, economic decline during which economic and industrial activity are reduced. Generally defined as a fall in GDP or GNP, depending on which large macroeconomic statistic you want to use, for 2 consecutive quarters or longer. So if the economy shrinks, the amount of goods and services produced shrinks for 6 months in a row or 2 consecutive quarters, we talk about that as being a recession. Well, that's a general recession across the economy. But we can actually look at the statistics for particular industries. In the housing market, not just here in Las Vegas, but across the entire country, we have very clearly seen a temporary, it'll change at some point in time, significant decrease in the level of activity, transactions that have taken place. And that's marked by, recessions don't have to be, but they're often marked by levels of higher unemployment. This has been marked by higher levels of unemployment. We've seen it most specifically, most clearly in the number of people who are working as loan officers, loan processors, and loan underwriters within the mortgage lending community. Right, and some of those numbers have seen really significant drop-offs in the number of people who are working in those banks, in those credit unions, in those mortgage banks and other lending institutions. But we've actually seen it really significantly. It's just a little more hidden in the employment in real estate itself. In 2024, 47% of all realtors, let me define a realtor for a second. A realtor is somebody who has gotten their real estate license from the state in which they practice real estate. And they've joined the local Realtors Association, which means they have access to MLS and lockboxes and all those kinds of things. And they're members of the National Association of Realtors. The most serious real estate agents are people who become members of the Realtors Association, right? Because otherwise you don't really have access to deal flow. You don't have access to lockboxes. You don't have access to the things that allow a realtor to actually engage in the activity of real estate. So the most engaged, the most likely to be successful real estate agents are realtors. It's a statistical truism, whether anybody happens to like that or not. It's a statistical truism. So 47% of realtors saw 0 transactions in 2024. Right? We got the end of the year statistics now. Throughout the entire 12 months, 47%, almost half of all realtors, no transactions. Right? And it's not like there was a big bump. Well, the other 53% all saw, 12 or more transactions. No, actually, the next biggest group saw only 1 transaction. So if you did no work whatsoever for 12 months, A, it makes it hard to survive, and B, it means that because most realtors are actually independent contractors, they are not W-2 employees, they don't get a salary, they just earn in the business that they created, which was their real estate business. 47% of those people, half of the industry, effectively became unemployed in 2024. Now, people might maintain their license for longer, pay their dues for longer. They may not have exited the business, but effectively half of realtors became unemployed. So we've seen dramatic drop-off in transactions, and we've seen huge impact on employment among realtors, as well as very significant impact in employment among those involved in the mortgage business. Okay, so let's look then at some more statistics that show the impact of this recession in the housing market. So we're going to do this by looking at 12-month rolling sales across the valley, resale single family. But we're going to take a broader time lens to understand a little bit more clearly about what's actually been taking place. Because looking at just the year 2024 in isolation, hey, we were up, we did better than 2023, does not actually tell much of the story. So 2018 should have been a fairly normal year in real estate in Las Vegas. We were clearly beyond the impacts of the great financial crisis that really devastated the housing market here and the overall economy in Las Vegas from 2006 through 2012. Still saw a lot of recovery from that through 2016. By 2018, we were running pretty normal. Well, 12-month rolling sales for single-family homes, 31,377. Pretty normal year. By the way, prices that year were up 10.5% year over year from 2017. So we had good appreciation, we had good home sales. 2019, the full year prior to the pandemic lockdown, we had 30,714 sales. Fairly normal year. We had come down 650 home sales approximately during the course of 2019 relative to 2018. but we get fluctuation year to year in the data. So that's normal. But we also saw prices in 2019 go up 6.7%. And these are median sale price, median sold price, 6.7% over the price that we had seen in 2018, right? So we had a little better than normal price appreciation. We had good sales that took place in 2019. Not blockbuster, but good sales. What happened in 2020? The economy was closed. A lot of people thought the end of the world was here, and you started seeing huge numbers of predictions from people in blogs and video blogs and YouTube videos and newspaper articles and on the news about how housing was going to be terrible. I remember a conversation I had with my brother when I told him, you might want to think about getting a house at this time as an investment because housing prices are going to go higher. And my brother literally told me his financial advisor told him housing prices were going to crash 21%, which I thought was funny because it was a really specific comment, but I also knew that it was just completely wrong. Well, what happened, sales, resale single-family homes in the Las Vegas Valley went up by 153 units from 2019. They went up to 30,867. And prices, they went up 10.0% by the end of the year, from the beginning of 2020 to the end of 2020. So clearly what people were prognosticating and commenting about and wanting to sound something about, wanting to be heard about, was just not what was actually taking place. And there were a variety of reasons for that, but that's statistically what actually happened. Housing number of transactions actually closed higher than the year prior, and prices went up by 10%. Now, we did see the Fed in April of 2020 cut interest rates to Fed funds rate to basically zero, and that did pull down mortgage interest rates to around 3.5%. That's initially where interest rates kind of settled at in 2020. Now, in 2021, the rolling 12-month sales, well, we all know they were a lot higher. In fact, we hit record high sales in Las Vegas Valley, 37,763. Highest level ever, almost 7,000 higher than the prior year. And median sold price went up by 24.8%. So if my brother had listened to me in 2020, he would have just been sitting on a 25% increase in the value of the property that he got. But a lot of people were clearly, 37,000 transactions, a lot of people were clearly following the advice that I was giving and or just on their own, really wanting to decide to buy a house because they didn't like being locked into some place that wasn't comfortable to them. And those people all experienced significant gains. Now, I will say real estate that year was incredibly challenging. It was really challenging in 2020, right? There were a lot of us who were working really, really hard, but at first we were locked in. The meetings were awkward. Everyone's wearing a mask. You can't be in the same cars. It became really awkward in 2020. In 2021, we had many of those same features in the marketplace, but we had so many multiple offer situations that if people were represented by an agent who didn't really know what they were doing or wasn't quick on their feet to give advice about how to overcome some of the challenges we were seeing in the market that year, a lot of people who wanted to buy were locked out. Their agents were being outcompeted by the agents who were winning for their clients. And so a lot of people who wanted to buy in 2021 couldn't, even though we had record high transaction volume. Well, what happened in 2022? In 2022, remember the Fed started increasing interest rates, actually at the fastest rate since 1980 and the second fastest rate ever that the Fed has tried to change interest rates. That started happening in April of 2022. In the first half of 2022, we actually saw a continuation of what was taking place in 2021. In May, that changed, and we hit peak prices, and then we saw prices coming down through the remainder of the year. In 2022, we had rolling 12-month sales of 26,420. That's a decrease of 11,000 sales from the year prior. Now, the year prior, 2021, record sales. 2022 was a very, very challenging year. Prices ended down 2.4%. So after having gone up the prior year by 24.8% across the valley at the median home price, they came down by 2.4% from the beginning of 22 to the end of 22. That meant that most of those gains that people had experienced in the prior years, 10.5% in 2018, 6.7% in 2019, 10% in 2020, 24.8% in 2021. Those were locked in, right? Those gains weren't being given back. We came down 2.4% on median sold price in 2022, even with those very high interest rates that we started seeing. Mortgage interest rates ended the year at about 5.5%. Well, in 2023, what happened? Total sales, rolling 12 months sales of single-family homes, fell another 6,150 approximately to 20,251. That was a drop of 30.5%, not from the year prior. That was a drop of 30.5% from 2019's level. 2019's level wasn't as good as 2018, definitely nowhere as good as 2021, right? But it was to the year before the pandemic, and so a reasonable comparison year. From then, we were down 30.5% in number of transactions in 2023. But prices at the median year start to year end up 5.3%. Then we get to 2024. 20,919 cumulative sales, rolling 12-month, for single-family resales across Las Vegas Valley. That is up, right, as we talked about. That's up it was up 3.3% for single-family homes, 2.3% across all housing types in 2024 relative to 2023. But we're just skidding along the bottom in this market. We're still only 68% of transaction volume of 2019, not the peak year of 2021, the year prior to the pandemic. 68% of closed transactions of that year. And by the way, the final numbers for 2024, prices went up at the median 5.3%, same as they did in 2023. So slower volume, very slow volume. And again, 47% of agents, 0 transactions. So low employment, low sales volume. Prices, they keep going up. And by the way, recession, the definition of recession says nothing about prices within the economy. So they say nothing about prices within the housing market. And we actually see generally, if we look over time, that prices for real estate go up year over year over year. There are a couple very specific exceptions to that, but they go up year over year. They go up during recessions, they go up not during recessions. And here we've got several years of actual real proof. Prices are going up even during a housing recession. Housing prices are not going to be coming down. They're not going to be crashing. And just to give you kind of one more statistic about what's going on in the marketplace, and you heard lots of commentators talking on YouTube and the news and et cetera, pick up Barron's, whatever news source you want, all about, there are tons and tons of foreclosures. So let's look at foreclosures. In December of 2024, there was one closed single-family residential foreclosure transaction. Now, that happened to be up from the November number, which was 0. So it was up an infinite percentage, but it went from 0 to 1. For the year 2024, there were more, right? There were 70 closed foreclosure transactions that took place in the Las Vegas Valley. 2.4 million people live here. 70 closed. And by the way, that number was down from the 75 that took place in 2023. We've got transactions taking place at a low level of volume. We've got prices going up. We have hardship in the marketplace for those who are actually working in the marketplace, like real estate agents, like lenders. We've got problems for sellers who want to sell and get reasonable dollars for their home. And we've got problems for buyers who are looking to buy, both in terms of what there is available to look at and in terms of what it's going to cost them on a monthly basis once they actually get into the contract and close on that sale. There's a very challenging marketplace that we're looking at here, but it's not resulting in foreclosures. And it's extremely unlikely to result in foreclosures. The reality is we have too few homes to show people. We have too few homes for people to live in. And so we're not going to see lots of foreclosures. It's just not happening. By the way, the annual appreciation numbers for 2024, I told you 5.3%. That's a single family number. For condos, prices over the course of the year were up 2.6%. For townhomes, prices over the course of the year were 10.6%. Now remember, townhome volume actually came down where condo volume and single family home volume went up, but townhome prices were particularly strong in 2024, up 10.6%. Now remember, because the size of the markets, right, 78% of all sales are single family homes, 8 point whatever percent it was is the townhome market, 8.3%. If we actually take a weighted average, that means that on the weighted average, prices increased in the housing market in Las Vegas in 2024 by 5.38%. So pretty good. We generally look at years to come in 5-6%, sometimes a little bit higher. So we're right there in terms of the kinds of housing price appreciation that we expect in the Las Vegas Valley in a normal year. So prices are up normally, even though volume is very low, with 47% of agents not doing anything. And by the way, that 47% number, if somebody in 2024 did as few as 3 transactions, they're in the top quarter of all real estate agents, all realtors in Las Vegas. So for those of you who are watching who are actually professionals in the real estate business, give yourself some grace. 2024 was a really hard year. We're in the depths of a really strong housing market recession here in the Valley and actually across the entire country. But if you're doing 3 or more transactions, you're doing really, really well. Some of us are doing extremely well. 2024 happened to be the second strongest year I've ever had, 2021 being the very strongest year. So there's differential outcomes for real estate agents and consequently for their clients. You want to make sure that when you're talking to real estate agents, you understand what group they're in. And I'm not meaning to put any of the agents down. There are a variety of reasons why things do or don't work out on getting into and getting through transactions. But if somebody has no experience from the last year, they have no experience from the last year. If somebody's got dozens of transactions over this past year, they're in a different category in terms of the information they can provide you, the help they can provide you, the guidance they can provide you about what's going to, in 2025, continue to be a really challenging year. And by the way, my market forecast for 2025 is sitting out there in YouTube on the channel. Please feel free to check that out. The forecasts for next year are that next year is going to be continuing to be challenging, right? The same kinds of issues that happened in 2022, the second half, 2023, 2024, high interest rates, as well as some additional challenges. They're still out there, and so we're going to continue to see challenging marketplaces. Now, I did mention I want to talk briefly about affordability. And affordability is this amorphous concept, and I don't want anyone to walk away with the belief that houses have become unaffordable. There's multiple ways in which price and the importance of owning a home or the affordability calculation become uncorrelated. And so there's multiple ways to increase affordability in homes. Maybe you buy with friends or roommates. Maybe you take a 40-year mortgage. They're hard to find, but you can actually look around and you can find them. A 40-year mortgage means you're locked into your mortgage for a longer period of time, but it also means you're probably paying at a lower interest rate. And because you're paying off the principal over 10 extra years, your monthly payments are going to be considerably smaller. So you could buy for a smaller monthly payment on a 40-year mortgage. Is it a good deal? If you're going to live in your home for 40 years, but it gets you into the home, it still might be a good deal. But the reality is, even though sales have slowed and increasing numbers of people are staying in their homes for longer tenures, the median tenure of home ownership on a particular property is about 10 years. That means you're not paying the back 3/4 of that 40-year loan. You're paying the first 10 years, and then you're out of the loan. You're into something new. So in reality, being in a 40-year loan is inconsequentially different than being in a 30-year loan. Now, there's a small effect because you're paying off a smaller percentage of the principal. It's not actually a quarter as opposed to a third, because you end up paying front loading. The way mortgages are calculated, the front load is mostly all interest. So you're paying off a smaller percentage of your principal balance every month than you think you are until you get very substantially through the loan. So you end up, if you can get a 40-year loan, saving yourself a lot of money, making your house a lot more affordable without actually costing you a whole lot extra. So we could very well see movement toward 40-year loans. We also have differences in housing types. So you might be able to buy houses that not necessarily what you would have bought several years ago, but could be incredibly valuable to you. All right, so affordability though, because of interest rates, in May of 2022, this is not inflation adjusted. I've not readjusted these numbers for inflation since 2022, even though they would adjust some, but this is still so recent, it doesn't make sense to go through the efforts of that calculation and use numbers that are not the ones that are widely published. For housing price, for example, 480,000 is what we got to in May of 2022. That was the most expensive, even on an inflation-adjusted basis, looking backwards over time, for single-family homes in the Las Vegas Valley. But that was just as the Fed started to increase the Fed funds rate very dramatically, and just as mortgage interest rates started to go up again very dramatically. And so we then saw from May of 2022 a decrease in prices, right? That resulted in a 2.4% decrease in the overall price from the beginning of the year to the end of the year of 2022. But the reason I want to point this out is that that $480,000 home in May came with a mortgage of 5.33%. And assuming a 90% loan to value loan, you put down 10% on the property and you borrowed 90%, the buyer was paying $2,391 per month. Now by July of 2024, we had actually come down in price and gone back up. And July of 2024, median single family home was back at $480,000. Same price, same nominal price. Inflation adjusted, be slightly different, but same nominal price. But average 30-year fixed rate interest on a mortgage loan in July of 2024 had gone up by literally 150 basis points, 1.5% to 6.83%. The payment on that same value home, median home, same purchase price, $3,139 per month. So no change in the purchase price of the loan, no change in the structure of the loan, both 90% loan to value loans, both 10% down. Same cost to get in, right? Same $48,000 10% down payment to get into both of those loans. But because the interest rate had gone up by 1.5%, that cost an extra $748 per month in carry cost. Interest rates have a really big impact. Now, interest rates came down a little bit, right, in the latter part of August, the first half of September, and then started going back up. And by the end of the year, we actually saw December median sale price, $460,000. Median sale price from July had come down $20,000. We'll talk more about that in just a couple minutes with the detailed descriptive statistics for December, but that $460,000 represented a $20,000 price decrease, but mortgage interest rates had gone up another 10 basis points to 6.83%. From 6.83 to 6.9%. That meant that that house would now cost monthly for principal and interest only $3,025. So that's a discount of $114 per month. But that was because the price had fallen $20,000. That had relatively small impact compared to what the higher interest rate impact was. Because remember, the prior two examples, May of 22 and July of 24, those prices were the same. It was only an interest rate impact. And the price had gone up. The carry cost had gone up almost $750. Another way to think about it is the interest rate in December of 24 at 6.93% was was 160 basis points, 1.6% higher than what we saw in May of 22. So May of 22 purchase price was $480. In December of 24 purchase price was $460, $20,000 less. But the impact was that you were paying $3,025 December 24 instead of $2,391 May of 22. That means you're paying in December on a $20,000 less expensive home, $634 more per month, only because of interest, than you were in May of 22. Now, I will say with regard to interest rates, clearly there's been some buyers who've been able to start to think about interest rates are probably not going down, and therefore it does not make sense to wait for interest rates to go down. Some buyers who are thinking, all right, if this is what it is, this is what I'm going to have to pay. You've got some sellers perhaps unlocking the value of their homes and the appreciation that they've got in order to sell, also even at these higher interest rates. But supply side is unlocking less rapidly than the buy side. Okay, so those are the sort of year in review numbers that I wanted to go through, but let me give you a couple specifics about December's transactions themselves. Sold. Now, I want to talk about this because it's counter-cyclical. We saw sales come down significantly, a little over 10% in November, but sales actually went up by 10.2%, increasing from 1427 to 1572 in December. Now, December is usually the weakest month of the year for sales transactions. This suggests there was some pent-up demand that we were seeing, and people recognizing that, hey, you know what, interest rates may actually be going higher in 2025. Let's just go ahead and get this done because I need to buy a house, kind of thinking. So that's good. It's interesting. It suggests that there's some strength in demand that a lot of people have been underestimating. This is a very counter-cyclical number. Way up year over year, but last year, 2023, was horrible. Okay, pending contracts fell, but they fell just a little bit. There is one significant attribute that I want to talk about. Pending numbers were down 1.7%. To 1433. Relatively non-weak. For December, it's actually seasonally fairly strong. But I do want to point out that's about 140, 139 fewer than we saw closed in December, which suggests that January's numbers are going to be a little bit disappointing. So just be prepared for that. January sales numbers are likely to disappoint on the low side. Possible we get some really early January activity, but I think probably not. I think December was just stronger for sales than we anticipated. The good news on pending is the drop was very minor, so we don't really see a lot of additional deterioration taking place. Okay, now where it becomes more interesting is the for sale inventory and the new listing inventory, right? The supply numbers. Supply for December, end of December of 2024, standing inventory, 4,951. This number is down. It's down substantially. And we would think that December would be down substantially. It was down 17.2% from 5979. So down almost, well, a little over 1,000 units in December relative to November for standing inventory, for standing for sale, single family resale residences in the Las Vegas Valley. The problem is that supply number came down 17.2%. At the same time, the transaction demand numbers increased 10.2%, and demand pending numbers decreased by only 1.7%. What that means is the inventory picture actually deteriorated significantly. The supply picture deteriorated significantly in December relative to the demand measures. This means that we're eating through inventory again, and we're eating through inventory at the same time that buyers are showing themselves be out there with demand, wanting to place orders on homes. Now, there's something else I want to talk about, and I've mentioned the past several months with regard to standing inventory, with regard to the supply in the marketplace. The median list price on those 4,951 homes that were for sale at the end of 2024, $549,000. So median list price. Remember, the median sale price was $460,000. That means that the median list price is $89,000 too high, basically $90,000, right? That's a lot. That means that a lot of the inventory is sitting out there is illusory, it's fictitious, it's not real, right? In fact, if we normalize the standing inventory to correspond by median list price to median sold price, what we actually find is there's not 4,951 viable homes for sale out there. There's 2,674. That's less than a quarter of normal inventory. We're scraping the bottom on what's available out there. And remember, let's give an example here. Let's say you've got three people who are really interested in buying a house, and they're really interested in buying a house with a budget of $500,000. And they go out and they look, and they find there's only one home available. Well, you've got three buyers competing for that one home. What happens? Maybe they bid the price higher. Maybe one of the buyers gets the home at whatever price. The other two buyers are still sitting out there really wanting to buy, and there's nothing for them to buy. Okay, well, that would be a problem. But now let's say there's actually three homes for sale. You've got three buyers, you've got three suppliers of housing units, and they're all, priced at about the same amount. But one of the buyers sees a house they really love, and they're like, okay, I'll snap it up. and they get it. And another one of the buyers says, there's only 2 houses left, and I don't really see anything I really want, but I need to buy a house. And they go ahead and they snap up one of them. And so now there's 1 buyer and there's 1 house, and that's all that remains. And that 1 buyer looks at that 1 house and says, I don't like it. It's not where I want to live. It's not in the right neighborhood for me to live in, because it's going to saddle me and my kids, if I have them, with really long commutes for work and for school. It's going to not have enough bedrooms to accommodate my needs. It doesn't have a large enough yard, or the yard is too big, but it's never been planted and I'd have to put in all sorts of money, whatever it is. When you get really small inventory, it doesn't matter if you have an exact match with the number of buyers and sellers. Every individual house has its unique attributes, and therefore not every buyer is looking for every house that has the right price on it. So we've got sold 1,572 in December, and we have standing inventory of 2,674. Well, it sounds like, okay, well, we have an extra 1,100 houses that are out there, but these are spread throughout the valley. These have multiple different bedroom counts. These have multiple different HOA fees. These have multiple different whatevers attached to them. And by the way, somebody might be looking, these are the median list price to match the median sale price, but somebody might be looking for a house that's in the $400,000 price point, and still within that median, the remaining house is at $600,000. So we've got incredibly little inventory, and that little inventory is now really constraining what buyers can actually buy. And that's holding down transaction volumes, in addition to interest rates holding down transaction volumes. Well, that's December data for 2024. That's the January market update for January 2025, and that is the 2024 year in review video. It's a very, very challenging environment. We are in the depths of a significant housing recession across the whole country, but especially we're seeing it here in the Las Vegas Valley. It's impacting employment in real estate. It's impacting employment in lending for real estate. It's impacting buyers and sellers in terms of the numbers of transactions that can be achieved. We've got sellers who are very underrepresented in this market, even though we've got buyers who are saying, okay, whatever, I need a house. I'm going to deal with the interest rate because I need a house. So we've got demand. What we don't have is supply. And this is going to continue. A lot of agents with 20, 30, 40 years of experience think, well, once we get to spring, we'll see a lot of supply entering back into the market, that these are normal seasonal trends. We're beyond normal seasonal trends here. And even if they were, remember, our demand trends have run counter seasonally. In December, we're already seeing that demand pick up, and we're seeing bigger than normal seasonal declines in supply in December of 2024. These conditions, yes, they'll change. They'll change on a monthly basis. We'll see the decline in supply probably settle down. We'll see demand continue to pick up. And like I had suggested in 2021 and in 2022, right? 2021, we were coming out of the pandemic lockdown. In 2022 and 2023 and 2024, demand is reemerging into this market more quickly than supply. And when that happens, prices go higher. We have very constrained supply, a quarter of normal. That's reasonable supply out there. And we have demand, right? And even if we take closed transactions as being the measure of demand, we're down from 31,000 transactions to 21,000 transactions. So we're down by a lot, but we're way above a quarter of normal demand, right? So we're down 10,000, or we're down a third in normal demand. and we're down 3/4 in normal supply. What's going to happen to prices? Yeah, absolutely. Hey, I am Justin Miller, co-founder and principal at the Chong Miller Group. If you find these videos to be interesting, helpful, please smash the like button, hit the notification bell, you know what to do. But even more importantly, please share these videos. These are really important insights that I share with all of my clients, and I make available to the larger public of practicing real estate agents and lending officers, and also to people who've not yet hired me. I can help you through the process, but I can also help anyone that you know, friends, family, colleagues, neighbors that you know who's looking to sell or looking to buy in this really challenging market. And it is a really challenging market. I look forward to seeing you in the next video. Thanks. Bye-bye.